Yeah, they're all out of Cowboys jerseys at the store. And when I have been here before and I've always said go Birds, I don't think I was clear. What I meant was Ravens. I think you thought I was talking about Eagles, but I wasn't. I was actually talking about the Ravens, who are still in the playoffs. All right, so thanks for having me, everybody. We'll talk some interest rates for the first time in almost 2 years. Should have at least some good news on interest rates. Can't speak to the football team here in town, but interest rates should be beneficial. So let's talk about financial conditions. So I've told you guys in the past, this is my favorite graph. This is the most important graph in the presentation. This will probably tonight be the second most important graph. If monetary policy is the inputs, financial conditions are the outputs. Okay, this is what the Fed looks at to measure the impact of their decisions. And so this factors in things such as actual interest rates, volatility, forward guidance, commodity prices, all those sort of things. Basically, is it hard or is it easy to do a deal? And if you look down there in the bottom right-hand corner, 2021, you can see the low point. That was all-time accommodative position, right? It meant everything was conspiring for tailwinds to get deals done. The horizontal line is sort of when you cross the threshold, and above that is restrictive. The Fed views that as sort of applying the brakes to the economy. Okay, they're trying to slow things down that's overheated. So you can see at late 2021, it starts climbing, and it climbs really aggressively all that time. So I was on a panel almost 2 years ago. It was March 22, the month that they started hiking, and it was sort of like point, counterpoint. It was me and this Fed economist. I am not an economist, so my limited, uneducated opinions are just around interest rates. If you have questions about gold, I can't answer them. I said, I don't think you guys are going to be able to get rates, Fed funds to 2.5. I don't think the economy is equipped to deal with you guys pressing on the brakes that hard. And he said, you're thinking about it the wrong way. He's like, because until we cross that threshold, we are not applying the brakes. We will keep hiking and keep hiking and keep hiking. And that's us taking our foot off the gas. It is not the same as applying the brakes. It's not until we get above that line that we're applying the brakes. And that didn't actually happen until Fed funds got up to about 4%. So it was at that meeting that I realized, we might be going higher than 2.5% in this cycle. All right, so December, this was the pivot party. Powell came out and was much more dovish than anybody expected. And he didn't really have a ton of reason to be. Okay, if you look at the headline data, there's nothing that's so weak that would suggest that he has to send signals that they're done or they're cutting or any of that stuff. So it really caught a lot of people, me included, off guard. The Fed is projecting 3 cuts this year. So they themselves are projecting 3 cuts this year. So it's not just everybody speculating. The people in charge of this are saying, we're going to be cutting 3 times, we think. Now, keep in mind, they're terrible at this, okay? So take that with a grain of salt. Just 2 meetings ago, they thought they were still hiking one more time this year, right? So they're wrong, and they're wrong just as often as everybody else. The market says, yeah, well, if you think you're cutting 3, that probably means you're cutting 6 times, right? That's historically how wrong you guys have been. The odds of a cut in March, now this has changed this morning, but the odds of a cut in March did get as high last week as 81%, okay? I think that is overblown. I think it's more like a coin toss. They're back down to like 61% today. Odds of at least 2 cuts by June were 99%. And the odds that Fed funds will finish the year above 4.5 is 0%, right? So the market is saying Fed funds at the end of this year will be below 4.5, right? The Fed themselves are saying 4.625, right? So it's not wildly out of bounds to say it'll be below 4.5, but just keep in mind, the Fed is cutting interest rates this year. They will not stay on hold all year. So how many next year, or this year? I would say my base case scenario would be 5 cuts this year. I think Fed funds will probably get down to about 4.25. I think there's a chance maybe 4%. The market has it rated at 4, maybe a touch below. Fed is at 4.62. What's interesting to note is the longer you stretch that timeline out, if you go out a couple years, they all sort of converge. Even the Fed themselves are saying, hey, Fed funds is going back down to sort of 2.5%, 3%. No one thinks that 5% is the new normal. And I think there was a lot of fear of that. Mike was talking about how it just feels a little bit better right now. And I think it's maybe just because there's a light at the end of the tunnel. that for 18 months, we didn't really know what the light at the end of the tunnel would be. It was like, they're just gonna keep hiking forever. And rates will never be below 15% again. And this is just never gonna stop. And it's like, okay, they finally stopped. We're starting to pivot. Things are cooling off. 5% is not the new normal. We will see them coming back down. And Powell himself has stressed 5% is not the new normal. We will be cutting interest rates. That he thinks rates at 5% is them applying the brakes pretty significantly, okay? And I think that's really crucial to understand why we know that they're gonna be cutting this year, is because they view this isn't neutral territory. This is deeply restrictive. This is them applying the brakes. They're gonna have to let off the brakes to try to avoid a crash landing. So I said the financial conditions was the second most important slide. I would say this is probably the most important slide. This is going to be a slightly tricky concept to explain, but I'll do my best here. This is where I got the lecture from that Fed economist and the light bulb went off and I was like, okay, these guys are playing a different game sometimes. When you look at economists in general, they talk about real rates. They don't just read the rates in the Wall Street Journal, the 10-year Treasury. We all talk about 10-year Treasury at 4%, right? They don't look at it that way. They always talk about rates adjusted for inflation, okay? And so what you had for a long time, inflation above interest rates, is negative real rates, which is very accommodative. It's like throwing gasoline on a fire, right? Look at 20 and 2021. Inflation is up, core inflation is up over 5%, interest rates are at 0. So real rates were -5. So it felt like you were borrowing at negative interest rates. That was why things were going so haywire. Remember that very first graph I showed you? We had an all-time low on the graph and it was the most accommodative the economy's ever been. It was because of that. So they start hiking. In their minds, they're not applying the brakes. They're just taking their foot off the gas until those two lines converge. That happened in spring of last year, right? From that moment on, the Fed is like, we are now applying the brakes. We are actually cooling things off at this point. We're not just taking our foot off the gas. So now we have positive real rates because Fed funds is above inflation. And so just using round numbers, if Fed funds is about 2% over inflation, we have a 2% positive interest rate, okay? That's the number Powell has said in his press conferences. He has said it's at least 2% and some metrics are higher, okay? That is the braking action on the economy. As long as inflation continues to trend lower, and everybody thinks it is, including the Fed, he can cut and still apply 2% of braking action on the economy. If he doesn't cut, it actually gets worse. He's actually slamming on the brakes. So from his perspective, he's like, as long as inflation keeps going down, it's been going down about 0.2 every month, right? 3.6, 3.4, 3, 3.2, and it's just moving lower, right? And the Fed is now thinking it's probably gonna be around 2.4 at the end of next year. As long as that happens, I have to keep cutting just to apply the exact same amount of brakes to the economy. If I don't, I'm actually making it worse. I'm running the risk of crashing this. And I also think that 2% in his mind is actually a pretty high number. That over the course of this year, he's actually gonna make that number smaller, meaning he's gonna cut faster than inflation is falling. So instead of 2%, this time next year, I wouldn't be surprised if we're really like 1%. He only wants to apply 1% of braking action, right? So that's why I think there is, absent inflation reaccelerating, which is almost mathematically impossible with the shelter component, the way that thing lags. There's no way that they're not cutting, and there's no way they're not cutting significantly this year. And significantly, at least 3 or 4 cuts, right? More likely 5 to 6, and then there's also the downside of the economy actually does run into a wall, and they'll be cutting significantly more. They're definitely cutting this year, right? And it's to maintain that same amount of braking action, and you could basically just say, here's what inflation is going to do this year, add 1.5 to 2% to that. That's probably where Fed funds is going this year. Interest rate cap prices, I know they've become a 4-letter word. They have fallen off a cliff, right? They're down 50% since October, right? We have sort of 1, 2, and 3-year cap prices here, just showing October was the all-time high. Most expensive an interest rate cap has ever been. It has since collapsed once the market sort of realized the Fed was done hiking, right? And then it exacerbated once Powell threw in the towel in December. We would expect that this will continue, right? And I think I probably showed you guys this last year. We went back and looked at how do cap prices behave after the last hike. And it was like, if we could just hang on into the last hike, we'll see prices collapse. They usually fall 50% in 3 months. You just got to make it to that last one. July was the last hike. But what the Fed did better than any of us appreciated at the time was they kept saying higher for longer so much that we all believed them. Like there was a time in like August or September and everyone just sort of woke up and was like, oh wait, they do mean higher for longer. They're never cutting again. Rates are going up forever. And this is the new normal, right? And then like by October, like, wait a minute, that's not how it works. They're full of it, they're tricking us. And we all sort of just woke up simultaneously and said, they're not gonna do that. Guess what, cap prices came collapsing down. 10-year treasury went from 5 to 4, right? It's because everyone sort of realized they've just been talking tough and they're not actually gonna do anything. So it behaved like we still had a hike left on the table, even though they actually didn't hike. That's how powerful Fed speak is, right? Fed speak very frequently is just as effective as an actual rate hike or a rate cut. That's why they don't want to mention rate cuts right now, because it's counterproductive, right? They do not want to spur the economy that much yet. As I said, the Fed isn't any better at this than the rest of us. So every other meeting is considered a quote unquote on meeting, all right? And what I mean by that is they release all these projections. It's called Summary of Economic Projections, SEP. We usually just refer to them as the blue dots because they release it in this graph. It's just these blue dots, right? It's these anonymous forecasts. They predict things such as unemployment rate, GDP, inflation, stuff like that, but they also do Fed funds, right? And so we went back and we took a look at all of the different projections and we saw how accurate were these guys as we rolled that forward, okay? So it might be tough to see from the back, but in that first row, it says overall, if I stretch out the timeline from left to right, goes out to 3 years, they're actually not that bad. In the grand scheme of things, they're not off by that much, which makes sense because they're in charge of it. So I would hope that they're reasonably accurate with it. The second line is during rate hiking cycles. Also not that bad. They tend to underestimate by 2-ish hikes within 6 months. I think we've all experienced that this last cycle, right? They kept saying like, well, we might be going to 1.5 or 2. We end up at 5. Like they missed it by quite a bit. But where they're really off is during rate cutting cycles. And so the box that I have highlighted there is at the 9 to 12 month mark. They usually think they're going to stop about 1.5 points before they actually do. So right now, if they say we're going to 462, what that probably means is they're going to 3, right? History would tell us they're going to 3, they just don't know it. So it's not totally out of the realm of possibility. By this time next year, Fed funds is at 3%. That's what history would tell us. Now, I think that the election will interfere with that sort of pace, so I don't think that's actually what's gonna happen. But history tells us they're wrong by 1.5 points every time they say, here's what we think is gonna be happening this year. All right, so this is the hairy graph. I made this when I was sitting on the Wachovia trading floor, probably back in 2004, because I was like, well, what's this forward curve thing and how accurate is it? And it turns out it's wrong all the time, and yet we all use it all the time. And so what I did was, this solid blue line is LIBOR, now SOFR, right? That's what actually happened. The gray lines are what was the forward curve saying at any given moment. And the general trend is most of the time the market overestimates the path of rates. We always sort of think rates are going to go up and to the right, nice and smoothly. They never do. But when the Fed is cutting, we overestimate the path of where they're going to stop, and we end up cutting way more. And so what that translated to in that far right-hand side is, generally speaking, the worst, just from a pure math standpoint, the worst time to lock in a rate is right now, because it usually means the bottom is about to fall out. When fixed rates are below floating rates, it's the market signal that the bottom is about to fall out. Fixed rates have been below floating rates for over a year now. That's the market signal. Now, we have a ton of borrowers who have gone from floating to fixed for a whole bunch of other reasons because they don't care about that math. And they're like, listen, I got a cap escrow number I'm sending in a check for every month. I don't care that this might be the worst time to lock. I'm just trying to get through this thing, right? Totally makes sense. I'm not here to argue about whether floating or fixed is better. I'm agnostic. But what history has taught us is when fixed rates are below floating and you think you can save money by going to a fixed rate, it usually doesn't last. And that at some point, floating is going to be lower than that. It's going to be quite a bit lower than that. And you'll probably have a yield maintenance or a prepayment penalty that's going to bite you when you go to exit. So what we tell our clients is just go into it with eyes wide open. We'll help you run the analysis. We'll walk you through all that stuff. If at the end of that, you're like, cool, I get all of that. None of it matters. I need out of this cap, and I just need a fixed rate that's a point lower to help my cash flow situation. Totally fair. I would make the exact same decision, right? But at least go into it with eyes wide open. Talked about the power of Fed speak and how effective it was at keeping interest rates higher for longer. It applied not just to Fed funds and rate expectations and cap prices, but also the 10-year Treasury, right? So this is another one of those graphs that says on the left axis, how does the 10-year Treasury behave after the last hike? And what you can see here is about 3 months in, it starts going down. So it kind of hangs steady for about 3 months, and then it starts going down. And if you stretch it out over sort of 6 months, it's usually about a point-ish lower, right? This time was totally different. It actually went higher, for the first time ever, higher. And that's because of that Fed forward guidance. That was Powell saying higher for longer and us all falling for it. So it misbehaved 4 months in, right? And again, it was sort of like October, November, all of a sudden we all sort of woke up and was like, wait a minute, they're not actually gonna hike again. They're full of it, they're just tricking us. Everybody sort of came to that same realization at the same time. 10-year Treasury went from 5 to 4, right? There was some questions at the beginning about like where we think the 10-year Treasury is gonna be, and I'll talk about this later, but I would also caution all of our fixed rate borrowers, don't assume that the Fed starts cutting, the 10-year Treasury is gonna push lower, right? That's not how it usually happens. It moves in advance. You're already seeing it move in advance. It's already priced in the cuts. From here on out, it's really, how much does it deviate from that original expectation? That's the thing to keep in mind. If the market says, you know what, things are gonna be okay, this is gonna be a relatively soft landing, 10-year Treasury is not gonna go down just because the Fed is cutting. The historical spread between Fed funds and the 10-year Treasuries, about 1.5%, right? So if the 10-year's at sort of 4, implies Fed funds at 250. You'd have to convince the market Fed funds are going below 250 in order for the 10-year Treasury to move lower, right? So just keep that in mind. It's like, I do think they'll probably drift about 50 basis points lower this year. Most of the movement has already happened, and that's what it always does. It doesn't matter if the Fed is hiking or cutting, 10-year Treasury moves in advance. It tries to price it in, and then it waits for Fed funds to catch up. So the current range, which we broke through today, sort of 394 to 405. Technical resistance levels going down, 368 and then 3.25. This is generally when you see sort of like the algorithm trading kick in, and this is when you see sell and buy orders that sort of put in a resistance or a floor. Going up, so we're at 410, I think we hit today, maybe 411. Usually, if it goes more than a couple days, it means we've probably broken that and we might be establishing a new trend, right? The next stop higher is 436. I'm not really that worried about us running up to 436 right now because we get core PCE next week and we get a job report the week after. Those are pretty big numbers for traders to be putting on big positions heading into those numbers. So I don't think that we'll see that. Just know there is some room for the 10-year Treasury to pop higher if you're pricing a deal here in the next couple weeks. The market has no clue, as evidenced by the different ways that you can measure that. It basically has the 10-year Treasury at 4% for the next 5 years. So it's essentially worthless. It doesn't know either, right? So don't listen to any of the Wall Street guys. So rents. I did a podcast with a shop here in town August of last year, or August of 22, and he was the first one who told me rents have cooled off already. We're already down to sort of 1-ish%. He's like, this is bogus. All these government stats are bogus. And that was the first warning shot across the bow for me that maybe the rent data that we were seeing in the government stats were a little bit artificial. And so what we have since learned is they are very, very stale, right? So this shelter component of inflation, if you guys haven't heard about this yet, like no one had heard of this 18 months ago, and a lot of people still haven't heard of it yet. It makes up a huge chunk of the overall inflation data, and it is incredibly stale. It's 12 to 18 months stale, right? So stuff that we're reading about today was actually set into motion a year ago, right? That's how stale this stuff is. And so it's not very good if you talk to an apartment owner saying, hey, rents are flat. Well, that's gonna show up a year from today. That's when that's gonna show up in those government stats. So we have had artificially high inflation ratings for the past year because we're still picking up 2022's numbers, right? It just hadn't worked its way through the system. That's why I said earlier, it's like mathematically impossible for inflation to reaccelerate this year because the shelter component from a year ago is finally kicking in and starting to pull those numbers down. So I have up here, it'll be tough to see in the back, but I have 3 different lines here. So the government's statistic is the light blue line, and that's the one on the very far right that's the highest, right? It's still up sort of around 7%, and it just recently sort of crested, right? But that's because it's stale. There's these 2 other measures that were built specifically to account for the time lag, right? Look when they peaked, much sooner, and they're down. One's negative. One of them has turned negative and then had started rebounding earlier this spring. It's already like, we've already hit the bottom. It's just gonna be a year before that shows up in the government statistics. This stuff will continue to drag on the inflation readings, and it wouldn't surprise me if we actually have hit the bottom and like rents actually do start climbing at some point. I think we were talking about, someone was talking about supply earlier, like that's gonna start to weigh on things. The government stats are very, very stale, and they know it. They know it as well, and I think Powell is factoring that into his decision-making process right now. So on the actual inflation data, that's not just the rents, it's just the overall inflation data, same sort of message here is, if you look at the monthly data, and so most economists would say, hey, that headline number, I'm measuring that off of something from a year ago. Like, that's helpful, but that's not really that doesn't tell me how things are this second. So most economists would say, give me the monthly data, at least 3 months, and then annualize it, right? If you take the last 3 months and annualize it, we're at 2% already, right? We're just waiting for the headline numbers to catch up. It's gonna take a while, but we're dropping about 0.2%. We might see core PCE, which is the Fed's preferred measure of inflation, hit 2.5% by the end of Q1 this year, right? If it's at 2.5% and it has moved off of 6.5% in just a year, the Fed is winning the war on inflation, right? Like they're now at risk of overdoing it. And I think that they're aware of that. So this inflation battle has been fun to watch for me because there's really 2 different camps. The first camp is the camp of we cannot afford to repeat the 1970s at any cost. We cannot repeat the 1970s. This is generally the older guard. So it's usually the owner of the company that I'm working with, and they're convinced this is a repeat of the 70s, right? So we took inflation from the 70s and then we overlaid the current inflation cycle on top of it. So the 70s is the dark line on the top graph. Current inflation is the light blue line. And it's kind of eerie how well they line up, right? So I get why people are nervous about that stuff. And so I called these 3 different mountaintops, different mountains. It's McKinley, K2, and Everest. We have summited and come back down K2, and it's like people are worried about Everest. Powell's worried about Everest. Don't allow inflation to go back up to 14%. Don't make rates go to 20%. We have to stamp out inflation. And the big mistake that they made in the late 70s was they stopped when inflation got to 5%. They didn't drive it into the ground to 2%, right? I'm in the second camp, which is I think that COVID is actually a lot like World War II, in that we had a labor shortage, we had supply chain disruptions, and we had a huge amount of federal spending, and it created this temporary surge that led to inflation over the course of a couple years, 2-3 years. But then it all went back to normal. It was not a structural change in inflation, it's just these things conspired for a burst of inflation. And you can see post-World War II, it actually dropped down below 0. So I wouldn't be surprised if we see inflation in the years ahead actually go back below 2. I don't think that's the base case, but I think it's definitely on the table. I think it's more likely that inflation goes below 2 than it goes back up to 5%. Do you guys know the story where the 2% target inflation came from? Everybody know this? So I like to ask people that we interview, analyst jobs, I'm like, well, why do you think the Fed has a 2% inflation target, right? Like, why isn't it 0? Greenspan said it should be 0, right? And Greenspan's kind of considered the godfather of monetary policy in the United States. And so the answer is because they want to spur just enough consumption that people keep spending. If you think something's going to be more expensive in the future, you're more likely to spend money today, right? And so you're like, okay, well, if it's going to cost me a little bit more to buy this a year from now, I can buy it today. And they sort of encourage spending that way, which is GDP, growth, all those things. So just enough, not too much, right? That's inflation, we don't want that. That 2% number, this is not a joke, came from 1989, a New Zealand central banker, off the cuff, told a reporter, yeah, I don't know, maybe like 2%, I don't know. And that was it. And then the next thing you knew, it had just been adopted by the entire world as the inflation target. And no one stopped to think, does this have any sort of research behind it? Is there a reason that this is the number? And it just got so widely adopted that it's almost like impossible to fight at this point. And so I'll frequently get asked, hey, what's the likelihood that the Fed just says, you know what, I'm not worried about 2%. It's a made up number, it's arbitrary. We're just gonna stop at 3, right? We're okay with 3. And my answer is, I think they would 100% love to do that, but they can't, because you can't change the goalposts in the middle of the game, right? The Fed's #1 tool is credibility. And if they throw in the towel before winning on inflation and getting inflation to 2, they lose credibility. So I think instead what they will do is say things such as, we're okay with inflation around 3%, and it's just gonna take a while to get to 2%. So they won't flat out say it, but what I do not think that they will do, I am certain of this, Powell will not drive the economy into the ground just to go from 3 to 2. He won't say, we're not going to 2, he'll just say it's gonna take a long time, right? So don't forget, like they cannot change the goalposts in the middle of the game. But the 2% number is totally made up. It was made up by a central banker in New Zealand, like not known as a hotbed of monetary policy thinking. Producer price index, like the lesser known cousin of CPI, the reason this one's important is it tends to lead inflation. So you can see that's the light blue line. Producers tend to experience inflation more than consumers, and then they don't pass it all on to the consumers, right? So you can see they peaked. PPI, core PPI, so that's the less volatile of the PPIs, got up to 10%. If you take headline PPI, I think it was up at 14, 15%, right? CPI got to 9, PPI got to 14, 15. It's come way back down, it's sub 2% already. Like this suggests that there's a lot of downward momentum on inflation that we're gonna be experiencing this year. I talked about that hairy chart that measured in forward curve expectations versus what actually happened. Well, there's the same thing for inflation. And so we went back and said, okay, well, what is CPI? That's just the dark solid line. And then the light gray lines are expectations. There's that expectation survey that gets printed every month. And so we laid that out there and we realized, holy cow, no matter what inflation is doing, because it doesn't hang out nice and neatly at 2% like we all think it's gonna, but that's how we all expect it to behave. We all think it's going to be nice and level, usually right around 2 to 3%, right? And yet it never behaves. Look at that thing, straight up and down, straight up and down. And so there's a lot of talk right now about like the last mile of inflation will be difficult, right? Getting from 3 to 2, it makes sense. Like that's an argument I can understand. The problem is we don't really have any precedent for it whatsoever. Inflation doesn't do that. Inflation just keeps going until they change dramatically, and then it rebounds and goes the other way, and it just kind of seesaws back and forth. So that's why I would not be surprised if we actually see inflation go below 2% at some point in the next year, maybe 2. The JOLTS report, I lovingly call it the Jim Harbaugh of government data prints because it's a fraud. I've been doing this 20 years. JOLTS survey's been around the whole time. Never in my career, ever, had I heard somebody cite the JOLTS report as an indicator of the strength of the labor market until this past year. And I was like, what? I don't even know what JOLTS is. Like, where did this come from? I've been studying data like every week for 20 years. Now all of a sudden this thing's dictating monetary policy. So it's just a survey they take, they call people up and say like, do you have job openings out there, right? Never mind that, it's free to post jobs. So what's the downside of posting jobs? It's not the same as it used to be, right? In 2015, the response rate to this survey was 70%, 70%. The response rate today is 30%, 30%. People just aren't responding, and yet we're still treating the data as if it has as much integrity as it did in 2015. So that number, when you combine free job postings online, infinite number of job postings, to me is totally bogus, and it's already collapsing, right? So I believe that the labor market is doing okay. I just don't believe it's doing as well as the media would lead us to believe. This unemployment momentum, this is a cool index that SMBC, some of you guys might have interest rate caps from SMBC. They've got a great research team. So they just basically take the unemployment rate minus the 24-month moving average, right? And anytime there's a horizontal yellow line right there at 0%, anytime we break above that, we've had a recession every single time, right? Well, we just broke through it last month. So it just seems very unlikely to me that we won't have a recession or be so close to a recession that it feels like a recession. Those of us in this room probably already feel like we've been in a recession for 18 months. I think we felt the pain first and we'll probably recover first as well. Another issue I have with the jobs is that they're kind of centralized. It's not broad-based like it used to be. So here, 96% of all job gains the last month were healthcare, social assistance, leisure/hospitality, and government, right? This is not broad-based job growth anymore. Almost every job gained is in just those 4 sectors, and the government makes up over 50% of that, right? That to me is not the same as a small business creating a job. The SOM rule, there's the former Fed economist named Dr. Claudia SOM. She came up with this rule, basically said, when unemployment climbs by 0.5 point in a year, we have always had a recession, right? The trigger for this number right now is 3.94%, right? So we're on the cusp of triggering that. And the other thing you notice here is it kind of just spikes, right? It's kind of moving flat and then it spikes. There's a great Bloomberg economist, Dr. Anna Wong, and she said that markets are dramatically underestimating the possibility of higher unemployment. That the statistical models that people are using are underestimating that. And so like her sort of 2 standard deviation move this year is best case scenario unemployment is like 3.4%, right? We're at 3.7. Worst case scenario is 7.2. 7.2 feels like a number that is impossible. It's at 3.7, that's not possible. And she's like, yeah, but that's how it normally happens. It always feels like it's stable and everything's gonna be fine until it's not. And then it surges unexpectedly and very quickly. So I think it's going to 5. She's saying, it's not base case. I'm not saying it's going to 7. It's not off the table though. The other thing is the participation rate, before I touch on this. If you aren't looking for a job, they don't count you. It's such a weird stat to me. They literally just don't count you. If James is like, nah, I'm just good. You guys are talking about fucking off, right? Guess what? You don't count anymore, right? But you were looking for a job up until last month, and now you're like, I'm fucking off, I'm out, right? They stopped counting you. Last month, 700,000 people stopped looking for jobs who had been looking for jobs the month before. 700,000. That's the only reason unemployment isn't 4.1% right now. We just didn't count them. If we had counted them, unemployment rate would be 4.1, the SOM rule would have been triggered, and there would be a lot more people talking about recession right now, right? So to me, it's just sort of like shady math that we're just sort of forgetting that all this happened. It's like, guys, what's happening here? Every month for 13 straight months, we have gotten a jobs report and the headline in the newspaper says resilient, strong, great jobs, surprise to the upside, right? Never mind that they're also printing a retraction from the last 2 months. Say, by the way, last month, we overdid it by 71,000. My bad, we gotta lower that number. But it's like when the newspaper prints that retraction on page 6 in the tiny font, but distracts you with the headline on the front page, right? The labor market is not doing as well as everybody thinks it is. I think it's okay. When I went to school, 5% unemployment rate was full employment, right? I think it's doing okay. It's just not as strong as people are saying it is. And if you go back, we like to measure things from like the moment that the yield curve inverted. That was 18 months ago, right? The yield curve inverted 18 months ago. We did a white paper in 2016 that showed on average, from the time the yield curve inverts to the time we have a recession is 18 months. So right now, right? We did the same thing for unemployment rate. And so the first 18 months, that's where that green arrow stops, is the 18-month mark. All those different cycles, unemployment didn't change that much for the first 18 months. It's kind of flat. Labor markets are terrible leading indicators. Terrible. You go back to the financial crisis, the unemployment rate peaked a year after Wachovia, my bank, went under. Unemployment peaked a year later. It's not a good leading indicator, right? So for the first 18 months from the time the yield curve inverts, not much change. The next 18 months, it usually climbs a couple percent. So 5.5% unemployment seems pretty reasonable to me in the next 18 months. It's not as strong as the headlines would suggest. There's a great leading economic indicators grid, shows we're down at levels that we've always experienced a recession, right? I think most of us in this room have felt this pain over the last year or so. People who are not in interest rate sensitive sectors, maybe less so, but there's no doubt that most of the general sentiment is negative. One of my sort of speculations around why Powell was so negative in December was because I think behind closed doors, he's getting information from all the different Fed banks. They have regional banks all over. Dallas has one, right? Those Fed officials are reporting to him what they're hearing from the community leaders. And what I think they're hearing is things are slowing down. That you guys have been applying the brakes all year, and we're actually seeing the effects of that now. Even if we haven't seen it show up in lagging indicators like inflation or labor, we're hearing it. We're hearing people aren't putting up job postings anymore. Powell heard that, got spooked, and changed his rhetoric in December, right? Quantitative tightening. So this is the Fed's got this enormous balance sheet now. They did own over 9 trillion in treasuries. They have been reducing that. They're like trying to pay off credit card debt, right? Like they're trying to get down to a more responsible level. But as they do that, they're impacting liquidity in the market. And we haven't really felt it yet. So this has not been a headline yet, but I think it's coming. That light blue line is Treasury Illiquidity Index. And if I were to zoom out, it would be nowhere close to 2008. So we're not like in anywhere sort of like alarmist state here, but there is no doubt that it spiked. That other spike you can see there was heading into COVID. And that other blue spike at the very beginning was when we had sort of a market seizure. You guys probably don't remember in 2019, temporarily short-term rates spiked 5% one day. It was really crazy. We're seeing illiquidity issues start to pop up, and I wouldn't be surprised if we start hearing about stuff in the market sort of seizing up, right? And they will absolutely intervene. The Fed will not mess around with market liquidity, right? That they believe that their job is to provide financial stability. I always sort of say like they've got this dual mandate of labor and inflation, right? But I think they have a super mandate of financial stability. They will not allow financial stability to be threatened. Which brings us to my favorite Fed shell game. SVB happened March of last year, right? And largely what it was about was they had a ton of treasury holdings that as rates had gone up, had dropped in value. Banks are not required to market US treasuries because the idea is the federal government is 100% going to pay this back and bonds always mature at par, right? So if you just hold this to maturity, you're not going to lose anything. I know that the market value, if you had to sell today, would, but you don't have to, right? SVB happens, that's what that dark blue line is. That's when all these banks rushed to borrow money from the discount window. The Fed is also the lender of last resort to banks. And if you're a bank and you're about to go under, you can go to them and say, I need to borrow money right now. SVB collapses, and what do? A whole bunch of banks run and say, give me cash, just in case there's a run on the bank. I need to survive this. SVB didn't have that opportunity. The problem with the discount window is there's a stigma, because you now just sent a signal to the market that you might have problems. And so that further exacerbates the problem. So banks try to avoid doing this at all costs. They do not want to do this. In 2008, in the financial crisis, the Fed actually made every single bank take money for that very purpose. They didn't want the market to be able to know who was weak and who was strong. So like Wells Fargo was told, you are taking money from us. I don't care that you don't need it. You will take money from us simply to protect the identities of the other banks. So about 110 billion gets borrowed overnight. Boom, right? The Fed says, we've got a problem. Let's create this emergency term funding program, and we will shift the money from the discount window over to this program, all right? That's why you see the dark blue line collapse back down to zero. And then the shading is the term funding program. That was started in March of last year. So they just shifted the money over. That's why I called it the shell game, right? Over the last year, 10 months now, it has gone from 100 billion and kept climbing. Last week it was reported 150 billion. This is supposed to be emergency measures. Why does the balance keep going up? Are banks in trouble? Powell keeps telling us everything's fine. Banking system's strong and resilient. I believe that the top 5 banks are totally fine. I think they're essentially GSEs, right? That they're the most capitalized institutions in the world. The regional banks, I'm not so sure about. And I'm not sure what their real estate holdings look like either. But they keep borrowing from this, even though we're 10 months past SVB. And if everything's fine, how come, right? This program expires in 2 months. In 2 months, this goes away. These banks have to give back $150 billion in cash to the Fed. What impact is that going to have on lending, right? What impact is that going to have on liquidity? And if things aren't okay, what is the Fed going to do? They're going to extend this program. So at some point in the next 60 days, if we get a message, hey, everything's totally fine, I promise, but we're just going to kick this can down the road a little bit, just next little extra, everything's fine. That tells me something's wrong. Something's going on back there that they're not letting us see. We don't get the identity of the banks who borrowed from this for a year after it closes. So March 2025, if they don't extend the program, is the first look that we'll have into which banks borrowed from this, right? This is set up specifically to protect these banks, right? And I was talking with one woman earlier, and she must have read the book Jekyll Island, which talks about the origins of the Fed. The Fed is a cartel, and that doesn't mean like drug cartel, like we're all used to watching. Cartel just meaning that it's a system set up to protect a handful of people, and those handful of people are the banks, right? The Fed does not work for us, works for the banks, right? Their number one priority is taking care of the banks. It happens to also benefit us, but when push comes to shove, this is what they're designed to protect. So to sort of wrap everything up, kind of the predictions, put it all on one page for you guys, and I think you guys will send this around. So core PCE, even if the headline number doesn't get to 2.0%, I'm very confident we'll be annualizing at 2%. Unemployment rate is going to hit 5%, and it's going to sneak up on us. The Fed will not wait for inflation to hit 2% before it starts cutting. The 10-year Treasury may touch 3.25, maybe even get down to 3, but I don't think it's going to stay there unless the wheels fall off. I think it's more likely to be sort of 3.5 to 4-ish% most of the year. Cap prices will continue to fall. Longer term caps will benefit the most. If you have a 1-year cap and it's at 3% strike, it's still going to be painful for the next several months. If you're looking at something longer, it'll actually benefit from the downward slope of the yield curve. Here on the left-hand side, Fed funds, again, about 1.25% of cuts, sort of 4 to 4.25 this time next year. And I think it's more likely that we'll finish below 4 than above 4.5, right? If the Fed's saying 4.62, tells me it's going to be less than that. On the 10-year Treasury, don't forget, most of the movement has already happened. Again, absent a total collapse in the economy, most of the move has already happened. If you're a fixed rate borrower, I would not sit on the sideline hoping for Fed or the 10-year Treasury to go to 3% just because the Fed starts cutting. That's not how it works. It's already priced that in. You've already benefited from it. At some point here in the very near future, we will see 2025 outlook will start to drive the 10-year Treasury more than 2024. At some point, the market's going to say, I'm actually more worried about next year than I am today. And then last but not least, quantitative tightening. I think that was that liquidity graph. I think they're going to have to stop doing that sometime, maybe this summer, maybe in the fall. That should allow for some downward pressure on Treasury yields.